Picture a Saturday afternoon in a British pub. The football is on. Someone pulls out their phone and opens Paddy Power. Someone else is halfway through a Betfair accumulator. The Sky Bet app is pinging notifications across the bar. These are not obscure financial products. These are brands that have been woven into British sporting culture for decades. Tens of millions of people interact with them every weekend. And the company that owns all three of them just shut the door on London for good. Flutter Entertainment has officially ended its secondary listing on the London Stock Exchange. The delisting becomes effective August 3rd, 2026. And while the announcement was quiet, barely a paragraph in a Friday filing, what it represents is anything but quiet. This is not a company that had a bad quarter and needed to reorganize. Flutter reported revenues of $16.4 billion in 2025, up 17% year on year. This is a company that looked at London, looked at Wall Street, and decided the maths no longer added up. That decision matters, not just for shareholders, for every person who still believes London is a serious global financial center. And by the end of this video, you will understand exactly why Flutter walked, who walked before them, and why the Chancellor's response should frustrate every single person watching this. If this kind of story is what you're here for, hit subscribe right now. We cover the business stories the headlines bury. Now let's follow the money. Flutter Entertainment was not always called Flutter. Cast your mind back to 2016. Paddy Power, the Irish bookmaker with the cheeky adverts, merged with Betfair, the British betting exchange that had changed how the industry worked entirely. The combined company became Paddy Power Betfair, listed on the London Stock Exchange, a member of the FTSE 100, a British institution in everything but name. In 2019, the company rebranded as Flutter Entertainment, a nod to Betfair's own origins, and continued building from London. It bought FanDuel and became the dominant force in the American sports betting market after the United States federal ban on sports wagering was overturned. It bought PokerStars. It bought Sky Betting and Gaming. It went on a decade-long acquisition spree that turned a London-listed bookmaker into the largest online gambling company in the world, operating in over 100 countries with nearly 16 million monthly users by the end of 2025. And then, in May 2024, it moved its primary listing from London to the New York Stock Exchange. London was kept on as a secondary listing, a courtesy, really, a way of not slamming the door entirely. But Flutter said at the time that the bulk of its business was now American, that the world's deepest capital markets were in New York, and that its valuation deserved to reflect that reality. It did reflect it, by the way. Flutter's share price performance since the move to New York has been exactly the kind of outcome that makes other companies' boardrooms take notice. And then, just a few weeks ago, Flutter reviewed the level of trading in its London-listed shares against the cost and regulatory burden of maintaining that secondary listing. The verdict was swift. Trading volumes in London were too low. The costs were not worth it. The London listing was gone. Here is what nobody is saying loudly enough about that conclusion. Flutter is not a small company that struggled to attract investor attention. It is the world's biggest online gambling company. It owns brands that every British sports fan recognizes. If even Flutter cannot generate enough trading volume in London to justify staying listed there, that is not a Flutter problem. That is a London problem. And it is a problem that has been building for years. Let's go through the names because the list matters. CRH, the Irish building materials giant that was a cornerstone of the FTSE 100, moved its primary listing to New York. Ashtead, the equipment rental company that generates 98% of its profits in the United States, announced its move to the New York Stock Exchange and described America as its natural long-term listing venue. Wise, the British fintech company worth around $15 billion, received shareholder approval to shift its primary listing to the US. Just Eat abandoned its London listing altogether, citing the administrative burden and costs of keeping it. TUI, Europe's largest travel operator, voted to leave the LSE in favor of Frankfurt. Arm Holdings, Britain's crown jewel semiconductor designer, chose New York for its blockbuster IPO, not London. In 2024 alone, 88 companies delisted or transferred their primary listing away from the London Stock Exchange. That was the largest single-year outflow since the global financial crisis of 2008. In 2025, another 50 followed. Think about what that sentence means. The scale of the departure from London has not been seen since the world economy was in freefall. And it is happening in peacetime, with no external crisis forcing anyone's hand. Companies are choosing to leave because staying in London costs more and delivers less. The numbers explain why. The aggregate value of the entire FTSE 100 sits at roughly $3.21 trillion. The S&P 500 is valued at $63 trillion. That is not a modest gap. That is a completely different weight class. UK companies listed in London trade at valuations that are, in many cases, roughly half what equivalent companies command on American exchanges. UBS calculated that CRH could experience a multiple re-rating when it moved to New York, where construction peers trade at around 25 times earnings versus CRH's 14 times in London. That gap is free money left on the table for staying patriotic. And here is the structural reason that gap exists, and it is one the government seems unwilling to confront directly. British pension funds have reduced their allocation to domestic equities from over 50% of their portfolios 25 years ago to just 4% today. Defined contribution funds now put 70% of equity allocations into international stocks. The domestic institutional investor base that once supported London-listed companies and underpinned their valuations has quietly dismantled itself. Foreign investors have stepped in, attracted by the discount, but opportunistic buying from overseas funds does not create the deep, liquid, loyal shareholder base that drives premium valuations. Companies listing in London are essentially being asked to accept a structural valuation penalty because the pool of committed domestic capital that once made London great has been redirected elsewhere. And when a company the size of Flutter runs those numbers and concludes that New York is simply a better place to be, you cannot blame Flutter. You have to ask who let the conditions get this bad. Which brings us to the Chancellor. Rachel Reeves has made growing the economy and attracting investment her central political pitch. She talks about it constantly. She has promised reforms to make British capital markets more competitive. And yet, while those promises are being made, Flutter leaves, Wise leaves, Ashtead leaves. Glencore, the mining giant, has said publicly it is exploring whether there is a better location to list. Flutter's own explanation for cutting its London listing pointed directly to high costs and regulatory burden as contributing factors. These are the same concerns being voiced by businesses across the private sector. Employers' national insurance contributions went up this year under the Labour budget. Corporation tax sits at 25%. The regulatory environment around listed companies in the UK involves obligations that, as Flutter put it plainly, no longer justify the benefit given the trading volumes. Now, if you are finding this useful, please subscribe. More of these coming every week, and you do not want to miss what comes next. The argument from the Treasury is that economic growth is the #1 mission, and that recent listings demonstrate confidence in British markets. And it is true that Canal Plus listed in London in December 2024, raising £2.6 billion, the largest IPO since 2022. There are genuine reasons for cautious optimism in certain corners of the market. But cautious optimism and structural reform are different things. What London is experiencing is not a bad run of luck. It is the cumulative result of pension fund divestment from UK equities, a valuation gap that has calcified over years, a regulatory and tax environment that companies describe as a cost center rather than an asset, and a political establishment that responds to each departure with press releases about a pipeline of future listings. There is a pattern here that should be familiar. When one company leaves and succeeds, the next board meeting at the next company has a very different conversation. CRH's share price outperformed after it moved to New York. Flutter's valuation has fared well in America. That is not a coincidence. That is a signal, and every remaining FTSE company is watching. AstraZeneca, one of London's most valuable listed companies, has laid out plans for a direct US listing. Shell has reportedly considered a move to America. These are not small players circling the exit. These are the companies that define what the London Stock Exchange is. Now bring it back to that pub on a Saturday afternoon. The Paddy Power app, the Betfair bet, the Sky Bet notification. Flutter Entertainment built those brands in Britain. British punters have made Flutter one of the most successful gambling businesses in human history. And the company that owns all of them just concluded that London is no longer worth the cost of a secondary listing. Not because of anything dramatic, not because of a scandal or a crisis, because the maths stopped working, because the trading volumes were too low and the regulatory burden was too high and the valuation premium simply was not there. That is a structural verdict, not an emotional one, and it is the kind of verdict that does not get reversed by a press release. The question nobody in Westminster seems willing to answer clearly is this: how many Flutters, how many Ashteads, how many ASRMs have to pack up before the structural fixes actually happen? Not the announcements, not the task forces, the actual policy changes that make London a place where companies want to stay. Drop your thoughts in the comments. Are you watching British companies leave and feeling frustrated by the response? Or do you think London's position is stronger than the headlines suggest? The conversation matters, and if this gave you something to think about, hit the like button, subscribe so you do not miss what comes next, and tap the notification bell. I will see you in the next one.